Hello everyone and welcome to today's major markets update for Wednesday, July 6, 2022. We still have the same three possible options as last week. Nothing has changed. We need to see breakdowns or breakouts to be able to eliminate several of these options. All right, here is a book by Ivan Goncharov, author of Oblomov. Oblomov is a very boring book. It is reminds me of the episode of Seinfeld wherein they try to introduce the series about nothing. So this is also a book about nothing. I haven't read the same old story, although Ivan Goncharov is a famous Russian author. I can highly recommend reading it if you're into good bedtime stories, but it's of course very philosophical and a lot about human psychology. Regardless, we still have the same three options, so I can go over those real quick and show you where we are still stuck in. Okay, this is option 1 or A. We can have a leading diagonal or a simple ABC wave A higher of a corrective bounce. Okay, I've showed you that one before. If I would show that on the daily chart, how that would look like. Let's see if I can find it real quick. I think it is this chart. This one. Let me just pull it up for you. See so many charts there. Wave A, wave B, wave C. So what does it take? We need to break above the late June high at around 39.50. Then this becomes operable. This option. Okay, we'll get a serious warning for the bulls if we break below essentially yesterday's low here at around 37.40, somewhere around there. That's a serious warning because that means we can target below the June 17th low. And if we target below that one, we are in the 1, 2, 3, 4, 5 setup lower to around 3,500. Hasn't changed. Again, we have a serious warning for the bulls when below about 37.40. This option is of course off the table when we break back above 39.50. Why? Because then the second wave, which is a possibility, cannot go above the start of the first wave. Okay, so that is the cutoff for this Elliott wave option. And a serious warning that this wave 3 is underway will be given below this level of around 37.40, about yesterday's low. Then we have another ABC going on. Okay, the alternative is a little bit twofold in this leading diagonal option, as I showed you before, of either this wave 1 or wave A. And we again need to see this breakout above 39.45 to confirm that wave 3 is underway. Potentially it's wave C of A to be determined. So that's this option versus this option. So we have two bullish options, one bearish option. The market will decide which one it is. And then we have a short-term bearish option, which is intermediate term bullish, and that this wave 2 here in green is subdividing into an A, a B, and a C into about this target zone between 36.75, 3700, and then it needs to reverse. If it doesn't, we'll continue lower, and then of course this impulse lower is the preferred option. Those are really still the same options. Okay, why? Because we've had 2 days of trading since last Friday, and pretty much not much has happened. All right, two things check, and you know what? That's the way the market goes. It dropped lower yesterday, rallied, pretty much did the same today. Not much progress. We really have to wait and see. This is a wait and see game. And again, we can drop to 37. Why then do we say we want to see this level hold? Because that is the serious warning. Okay, you don't want to bet on it that it's going to bottom here and then rally with the potential that we drop all the way to 34.90. Okay, so that is still a possibility of a complex wave 2, but I'm not going to hold my breath for it. Okay, that's pretty much where we're at. The cutoff for this option is of course below the June 17 low. That's of course the famous cutoff for the bullish option, both patterns, ABC versus 1, 2, 3, 4, 5. Okay, I really don't want to see it go below 37 36.75 on the S&P 500, and of course already below 37.40, somewhere around there, will really start to open that proverbial can of worms that I talked about on Friday. So same old, we haven't changed a single thing yet. Breakout, great. I'm going to look at these upside targets around 4,200. Breakdowns, I'm going to look to about 3490, says 3,500. Very simple. That's where we still are at. Let's see where we will be on Friday. The market will take its sweet time. That doesn't mean you can't trade it. Of course, you can trade it. You can trade breakouts, breakdowns, but always remember, use appropriate position sizing and use appropriate stops. Okay, I tweeted it today. One of the things that I look at is where is price in relationship to the, say, 200-day and 50-day simple moving average. If we get a dip and price stays above the 50-day, 200-day, you should buy a full-on position. And in this sense, according to my risk level, will only set your portfolio back 1 or 2.5% if that stop loss gets hit. Okay, that means you can do 100 to about 40, 50 trades before you've blown up your account. If all of them become losses, well, that would of course be very horrible and should definitely stop trading by then. But just to show you that that is a option. The next one is if you get a, for example, a price drop that goes below the 50-day. Well, maybe if it's below the 50-day, it's intermediate term downtrend. Technically, maybe you should only use half a long position. And if we also drop below the 50-day, so prices below the 50 and the 200-day, maybe you should only enter a quarter position. So if that quarter position stop gets hit, your entire portfolio will only see a drawdown of about 0.25%, maybe of about 1%, something like that. So very tiny losses, and then let it run. Okay, so you get bigger wins. That's really trading. Trading is nothing else but that. And again, some people will maybe not even go long when prices are below certain moving averages. But this way, you could still enjoy some upside and still make some money. If you have difficulties again with trading, please sign up for my ETF trading alerts. We have, of course, a few losing trades on the books, but in general, we're up double digits for the S&P 500 and the NASDAQ trades, combined with short-term and intermediate-term system. That is absolute market beating. These systems are up double digits, whereas the markets are down double digits. It's impossible to say that sucks. Maybe you do better, good for you. This is for people that simply want to spend as little time as possible on trading and get still a good return. Okay, that's really, I cannot stress it enough, because what's good for you is good for me and vice versa. That's really what I want. I want everybody to make trading easy, because what I'm doing here is simply interpreting the chart. That's all I'm doing, and you got to decide on how you want to trade it. That's all I'm doing. I'm not going to say anything about where you should buy or sell or anything. These are the options that the market has on the table, and you figure it out. That's all there is to it. Okay, I couldn't care less. That's really all. Because why? Because everybody has different risk levels, different time frames, all those things. And I cannot address 1,000 people with all the different needs. It's impossible. So all I do is present the options. And you don't have to make your choice. And if you want to trade it, not trade it, all those things. All right. Moving on. Here is the percent of stocks above the 50-day moving average for the S&P 500. The S&P 500 is made up of around 500 individual companies. And those stocks, of course, have their own 50-day simple moving average. And this indicator tracks the percentage of those 500 stocks that are above their respective 50-day moving average. I only have data going back to late 2002. Maybe there's more data available somewhere. I can't find it, but this is 20 years of data. I know the S&P 500 has technically been around since 1957. So we're definitely missing about 50 years of data, but this is as good as it gets, and this is all we have. Looking then at the data, when this indicator, it's kind of like a market breadth indicator, drops below 2.5 and then rallies back above 20, we kind of get a breadth thrust. This has happened 5 times over the last 20 years. So this is a rare periodic signal. 2 occasions were in bear markets. Here in late 2002 and here in late 2008. The other ones were during the same bull market, 2011, 2019, 2020. So I don't want to lump all of these together because we're kind of comparing apples to oranges. What we do see is that in 2002, price rallied, dropped, and then we had a big rally. Okay, same here, 2009. This is pretty much what initiated the whole bull market that we've experienced over the last 10 plus years. 2011, we had the same setup. We got the spike, got a lower low in price, but a higher low in the percent of stocks above their 50-day moving average. That is called positive divergence. And then it was off to the races for many, many years. 2019, the market never looked back. 2020, the market never looked back. So all of them were long-term, very good signals. Shorter term, there can be some downside risk. Again, this is a more longer-term perspective. So how good was this signal? All right, I summed it up for you. Here are the performance details. The downside risk is from the day we get the signal where it goes from below 2.5 to over 20 to the secondary low, as you could see here in 2003, 2009, or sorry, 2002, 2009, 2011. And there were no secondary lows in 19 and 20. That was just off to the races. In 2002, we had 15% downside risk over 2 months and 76% upside reward over 60 months. Okay, so that is a very good long-term risk reward. In 2008, 2009, because the market gave the signal in late 2008, but it didn't bottom until March 2009, there was 25% downside risk over 2.5-month period and 40% upside reward over 16 months. Now, what's the upside reward? The upside reward is from the day the signal was given to the high from when then the next larger decline would start that would then give a new signal. Okay, so that's your upside reward. Of course, your upside reward was much, much higher from here to here, but I'm simply looking from this level to this level, from this level to this level. If you can see my cursor, from this level all the way to this level, here to here, here to there. Okay, so that's the maximum reward. Just as we have the maximum downside risk, we also have the maximum reward. 2011, there was 10% downside risk over about 1.5 months, 145% upside reward over 86 months. 2019, again, no downside risk, maybe 1 or 2 days, but very minimal. We're looking long-term, 33% upside reward in about a year. 2020, no downside risk, 75% upside reward in about 20 months. So we have 5 signals that give us 3 small downside risks versus the upside reward. It is versus, right? You're kind of comparing the upside reward versus the downside risk. All of the time, the upside reward far outperformed the downside risk. What we also know is that this marginal lower low from a upside reward perspective, of course, 25% downside risk is nothing to mince home about. But then again, this depends on your risk management, on how much risk are you willing to take, and what is your portfolio's allocation and risk profile. All of it needs to be taken into consideration when you decide to, for example, act on a signal like this. So we have a condition. I know past performance is no guarantee of future results. Maybe we'll get not a good signal at all because we could be in a super cycle 4 wave, which is a market environment that is not captured by any of these signals. So we could be indeed comparing apples to oranges. But that's why we always have appropriate stops in place. So there is nothing to worry about other than losing a little bit of money. If you don't want to lose any money ever, then this should not be your name of game, but you should probably put it in a bank account and see the savings accumulate as the interest rates have been rising recently. Regardless, we have no opinions. We have 20 years of data. We've had 5 signals, and all of them led to long-term, which means a year plus, good upside reward. That's all we can trust. Whatever else we think of the current market, of the Federal Reserve, of the weather, of Biden, of Pelosi, of Putin and Russia, all of it doesn't matter. COVID, you name it. Whatever we think of it, it doesn't matter. These are the 5 signals we have, and that's all that matters. And then you can act upon it or not. Just wanted to share it with you. So there are still downside risk involved, of course. There is nothing that is perfect and only gives upside reward. But I did want to share it with you. So these are the 5 signals we have. We currently have a signal. I can show you if I zoom in a little bit here. Here is the signal. So we were below 2.5. So less than 2.5% of all the stocks in the S&P 500 were above their 50-day simple moving average. So today we're now at 27%, and you can see here on June 24th, it gave this signal where it went from below 2.5 to over 20. Okay, and then of course we're going to look at past performance. So if we go lower before we're going to move higher in accordance with the first 3 sequences, that would fit, of course, with this Elliott wave count 1, 2, 3, 4, 5, which is going to last into probably the end of June or July, sorry, somewhere around there. So that option is available. So of those 3 options, we got it covered by this Elliott wave count. Then we have the 2 options from 2019 and 2020 that say we're going to go straight up, so to say. That would then be covered shorter term with this option, with an ABC, and the 1, 2, 3, 4, 5, and ultimately, of course, a massive larger bull market, because that is then wave 1 of 5, we get 2 of 5, etc. That I cannot delineate yet, but we have a little bit of extra weight to the evidence, and that this could be considered a breadth thrust. Okay, whatever you think of the market, it's fine. This is what we've seen over the last 5 times, over the last 20 years. Worked out reasonably well longer term. To be determined how that's going to fit in with the bigger picture, but please keep this in mind. The PMO buy all sell all remains on a buy, believe it or not. It's been on a buy ever since it started in late June. And the last couple of days, it hasn't mattered. It's still on a buy, so that needs to be honored as well. Again, this is definitely not a perfect indicator, not at all. As you can see, the buy signal was given pretty much at the highs here at 39.50 for the S&P 500. So if one would have used this, one would still be underwater. This is interesting indicator in that sense of that it kind of determines more of a market direction than anything else, and the internal strength of the market. What I don't like is still the new lows, still too high. Way too high. We need to see it consistently below 50, as we've seen here in 2020 and 2021, especially for the earlier part. Those are quiet markets, okay? But I think we have a nice extra signal here. Call it a thrust, call it a condition, whatever you want to call it, that has worked very well over the last 20 years. Again, I don't have data available for the first 50 years of the S&P 500. I would have loved it to have that, because then we would be able to capture a lot more different market environments. But this is as good as we get. This is all we have. This is all we can go by. So that's really all I have for today. We're still stuck between a rock and a hard place. We still have the same old story. Okay, that's where we are. We still have these 3 options on the table. It is breakout, and then we get the A versus 1 wave, or break down, and then we get the impulse lower to 3,500. The A wave or the first wave should target around 4,200 for the S&P 500. All the other indexes pretty much the same deal, except maybe for the semiconductors, which have made lower lows. But the S&P 500 is in the same predicament as the NASDAQ 100 and the S&P 500. So we have the same parameters for those. All right, so that's all I have for today. It's a long enough story, especially considering there's not much to say other than the same old story as on Friday. So with that, take care, trade safe, and I'll see you all on Friday. Bye.